Today's presentation, we're going to break it into three parts, and the first part is going to be a reminder of the key themes that we've been talking about for all of 2024. It's the fourth year that we've rolled out key themes at the beginning of the year and been able to stick to those throughout the whole year without new issues emerging and dominating the agenda. So in January, we'll be rolling out the new ones for 2025. We're going to go through those real quick to set the stage for the rest of the presentation. The second part of the presentation is the market recap, and I'm even more excited about that than I am excited about us going to the aquarium for our holiday party. The Fed is getting out of the way of our economy. We've had an extremely restrictive policy for a long time and for too long, but inflation is under control, and so now the Fed can get out of the way and let capitalism do its thing. The third part is the market outlook, and the headline there is expecting the best, but, and I'll just remind you of some of the things that we're worried about, and in fact, we'll call those out in the key themes as well. So let's go ahead and jump into the 2024 key themes. The first one is we're a little worried that there could be a domestic political crisis that could test the markets because of all the divisions in the U.S. We may find out about that here in the remaining weeks of 2024. We're worried about geopolitical shocks. That is a long list, but certainly has Ukraine and Russia near the top. The Middle East, okay, maybe that's at the top as well. And we can never stop worrying about China and what that might mean for the global economy, as well as Taiwan. So far, so good in the sense that there's not been some major eruption that has tested the market there. We're also worried about volatility among individual stocks, and we look at AI as one of the many reasons that you could see that volatility. It's been a very odd year where the markets have just done great. I mean, it's been a fantastic year in the stock market. I think I said at the beginning of the year, I don't know if I've ever been more excited about the stock market than I am at the beginning of 2024. No recession on the horizon, but it's not a year I'd want to have a whole lot in one particular stock. And on a daily basis, we'll find a stock that's down 5, 10, 15%, maybe a handful of those on a slightly bad day. And that's just kind of unheard of. So calm markets if you're diversified, but not if you've got a lot of your wealth in just a handful of stocks, or in some cases, we've seen folks with a lot in just one, and you kind of get what you get, and it changes daily. The last key theme is a private market revolution, and that's really got to do with the legal structures, the administrative structures that are going to allow us going forward to quite often put money into the private markets when we want to and pull money out of the private markets when we want to. And we've covered that in past quarters, just a fundamental change. It's going to roll out gradually, but it is definitely going to make it easier to invest in private markets, maybe easier to invest more in private markets than we would have in the past when liquidity was a giant question mark. So we're going to focus just for a moment today on the first key theme that we just reviewed, and that is about the possibility that a political crisis may test the market. Now, I don't want to diminish the anxiety that some of the individuals on this call might feel, that people feel throughout the country and honestly throughout the world about the coming U.S. presidential elections. The final day to vote will be this next Tuesday. So we wanted to make sure we did all of our quarterly market reports before the election, not after, that they might be cheating a little bit on some of the things that we're going to predict. But I want for a moment for everyone on this call, try to just put on their investor hat with all the important things that are at stake in this election. For just a moment, maybe we could just pretend that our interest is as investors only. And from that more narrow perspective, I think it can be useful to look at the history of, in this case, the S&P 500, generally the 500 largest stocks in the United States, which is by far the bulk of the market cap, and just see how that has performed over history in the context of who was in the White House. And if you look at this chart, and I've been told that this has been very calming to some people, what you'll see is that markets have gone up over long periods of time under every administration. And I think the point here is to remind people that when you're investing in the stock market, you're really investing in a much larger system than who is in office at any particular time. You're investing in democracy, you're investing in capitalism, you're investing in the ingenuity and entrepreneurialism of the U.S. in particular. And so it's an investment in a system, a trust in a system that is bigger than any one particular candidate. And I think it's just really important to remind folks of this because over my career, it's not been all that uncommon for an investor to say, well, I don't want to be in the stock market right now until my candidate gets into the White House, or I'm worried about the election. When everything's all clear, I'll take that risk in the stock market. You certainly can't look back over the last few decades and find any particular administration where that turned out to be the right thing to do. Now, there's other things that intervene, such as pandemics and popping of the tech bubble and things like that, that I think to a large degree happened independent of who was in the White House. But hopefully the message comes through from a visual standpoint and helps those of us that are feeling any anxiety about what's to come to stick to our financial plan, stay invested in the long run. That's what's always worked. Now let's get into a quick market recap, and we'll move kind of fast here, but the headline, as I said, is the Fed gets out of the way. So let's start with the timeline of events, just looking back over the last 90 days, ended September 30th. And here's what the global equity index did over that period of time. It did end higher than when it started, and that's really been the pattern all year. Little bumps here and there from a variety of events. And boy, I tell you, I'd love to be able to spend an hour talking about all the events that happened in the third quarter. There's a few, though, that are particularly interesting to me that I'm going to call out for you. The first one listed here is just an interesting lesson. There was an election in the UK on July 4th of all days. And, the Conservative Party was thrown out. And you might ask, why was that the case? Why was there such a swing? And why was a party that had been in power for a long time thrown out? And well, there was inflation in the UK, just like there was in the US, just like there was in Canada, just like there was in Mexico, and certainly other parts of Europe. But the party in power took the blame, and so they got tossed out. You could argue maybe there was some other reasons for that as well, but whoever is in power when things happen that the electorate doesn't like tends to take the blame, as perhaps they should. But just a bit of a reversal of perhaps what's happening in the United States, we'll see, but an object lesson, at least in how an electorate tends to vote. There's lots of other things that happen, some good and some bad throughout the third quarter. But the one that grabbed the headline is maybe the third from the end. The Federal Reserve cuts rates by 0.5 percentage point. That's what the futures market was saying right before it happened, but many people were still expecting it to only be 0.25%. I had hoped that they'd start cutting rates at the beginning of the year, and they didn't. So for me, at least, they're still catching up. So I was very happy to see a 50 basis point rate cut right towards the end of the quarter. And of course, the market liked that and continues to like that. That rate cut helped to generate some of the benchmark returns that you see on this page here, and things have continued to evolve since then. If we just look at the top of the page with the fixed income index, what you'll see is an amazing 5.2% return for the last 3 months. Now, that's in light of the year-to-date return being 4.45%. So that was kind of interesting because interest rates fell across the yield curve. I mean, short-term rates fell and long-term rates fell just briefly. Keep in mind, however, that the 3-year return for the fixed income index is negative 1.39% per year. So obviously a lot's been going on there. And in fact, now, because of the Fed getting out of the way, interest rates have started to rise. You could see that as a vote of confidence in the economy. The year-to-date return, as we're recording this today, is less than 2%. So more than half of what you see in the year-to-date return has been wiped out. So I think it's a good thing that we do not index our exposure to the fixed income market here. Instead, we've been fortunate to take advantage of these higher short-term rates and have a very stable, predictable return for our clients that, at least as we look at things year-to-date at the moment, are significantly higher than the index. On the bottom end of this table, you'll see the global equity index. And again, as we're recording today, we're having a pretty good day in the stock market. Things have continued to move up. I'll look with a degree of amazement at the one-year return at the end of September 30th of over 30%. That's about 3 years worth of return when we look at what we'd expect to get in any sort of normal year and certainly going forward. So it is kind of funny to look at these tables and look at these longer term returns and try to remember back to all the stresses that we felt, for instance, over the last 10 years. And yet here we are with pretty decent looking returns over the last 10 years. Not so much on the fixed income side, where inflation has probably averaged more than 2% over the last 10 years, but you were taking all the risk out of your portfolio to do that. I guess the lesson over the last 10 years is if you're willing to bear the stock market risk and be long-term in your thinking, you were looking at least with the index, a 9.2% return per year. So yet one more lesson that being an investor for the long term is usually the best choice. We'll note that every major asset class had a nice positive return for the third quarter. I get to show all green arrows again, which I certainly like to do. It was nice to see the international markets do so well, and I'll explain some of that in a moment. But was a little bit surprised that real estate did as well as it did. It's not had the best stream of returns over the last few quarters, and we're certainly still worried about office space here in the U.S., but the real estate exposure that our clients have here, though it may be small, is also more likely to be in warehouse space and things like that that have done just fine. We'll start with fixed income, and normally we do that last. I'd like to call your attention to the top middle of this slide. That's what we call the Treasury yield curve, and this is where rates were. You see the blue curve on the bottom on September 30th. As I said already, since then, rates have begun to move up. We're also showing you where we were a quarter ago and a year ago, and you see the rates higher there. We're rapidly catching those. I think the main point perhaps to take away from the depiction of the yield curve is this dislocation, this twist, if you will, the kink in the curve on the short end. That is a surefire way of seeing that the Federal Reserve is out of touch with the markets. The markets are already telling us that the Federal Reserve is going to lower rates. So when the short-term rate is high like this, and then you get out just a few months and you see it lower, that's the market saying, come on, Fed, lower those rates. We know this is what you're going to have to do. Just come on and do it right now, if you will, and telling us that, in fact, the Fed is late. So we know the Fed's going to need to lower curves. There's trillions of dollars betting that that's the case. There's just the question of how rapidly it's going to do that. The market's certainly thinking that it should have done that already. Within the U.S. stock market, we can see that every part of the market went up. Perhaps a surprise to some people is the fact that small cap stocks did better than large cap stocks. That hasn't always been the case in recent history. And in fact, large cap growth, where a lot of the tech leaders live, did the worst. So small cap value did the best and large cap growth did the worst, at least for that quarter. It has been bouncing around quite a bit, but we have a bit of a tilt towards small cap and towards value for our clients' portfolios, and that's what's worked in the long run. And it was a gratifying quarter to see that work here. Of note also on this slide is the fact that the U.S. stock market is now 63% of the global total. So if you bought an index that owned every stock on the globe that could be traded, 63% of that would still be companies that are headquartered in the United States. And that was 61% at the beginning of the year, 60% a year ago. And about 5 years ago, it was 55%. And about 10 years ago, it was 50%. About 5 years before that, it was 45%. So whatever concerns or grievances we have about the way things have been run in the United States, our capital markets have just outperformed almost everywhere else in the world, and we continue to become a bigger and bigger part of the global capital markets due to that success. The international stock markets performed quite well in the third quarter, but it is a bit of a mixed story here. The good news is that U.S. investors, the folks on the call here today, got the best part of it. When you look at those returns on the top right, you'll see two different colored bars, and the darker bars, the higher returns, are the returns that we all got to enjoy. Once again, you'll see small caps did better than large caps, and value stocks did better than growth stocks. So that was nice to see. But when we see these different returns, the lighter bars and the darker bars, the lighter bars are what these markets did in their home currencies, but we're not investing in euros and all these other foreign currencies. We're investing in US dollars. And what happened is that the US dollar weakened during the quarter, which is just another way of saying that these foreign currencies we are invested in strengthened. So we got the benefit of being invested in foreign currencies. We got the benefit of those stock markets doing reasonably well, but those returns get added together. And so that range of returns 10.45 to 5.87, again, with us overweighting small cap value for our clients, are the returns we actually got to enjoy. Emerging markets was a similar story with regard to currencies. Maybe the big story is that emerging markets did as well as they do. Sometimes it's questioned why we have emerging market exposure, at least when we've had a few down quarters in a row, but it is thought that emerging markets tend to perhaps do better when U.S. interest rates are falling, and with the Fed set to lower interest rates even more, we're not expecting to pull out of emerging markets. And then here we get a quarter where they do quite well. In fact, the returns in the home currencies did far better than the developed international markets did. So little currency overlay, and that makes that even better for us. So we're hoping for better things out of emerging markets going forward. And just as a note, I'll show you how all the different countries that constitute the developed and emerging markets did for the quarter. Really just a point of curiosity. You may note that Thailand did the best, probably not something that any of us predicted, especially since last quarter it almost did the worst, certainly with negative returns. And yet for the third quarter, Turkey did the worst. And you may recall, and you can go back and look at the quarterly market report that was sent out to you if you want to check it out. Turkey did the best in the second quarter. So you've got this switching of roles back and forth, these reversals, if you will. And here we see the U.S. in green lagging just a little bit the global return. Again, our exposure to the foreign markets helped us to do a little bit better with our global strategy. But if you were to go back and look at quarter after quarter after quarter for dozens of quarters and add those up, you'll find that the U.S. just did terrific and was very near the top or at the top over that period of time. So being more diversified, sort of slow and steady, if you will, rather than trying to pick which country is going to do the best, has definitely rewarded our investors. And that's why the U.S. is now 63% of the global total. You might recall just a few slides ago, I was telling you how in the United States and in the international developed markets, value did better than growth. And I mentioned that that is usually what works. I wanted to put some data around that. And on this slide, we're looking at data that goes through 2022, but is nearly a century of data. And what we see on this slide is the following. Sometimes value does better. Sometimes growth does better. A value stock is a stock that is generally cheaper, meaning there's a lot of earnings that you get for a dollar invested in the stock. Growth stocks, the earnings don't tend to be there quite so much, but the company is growing more rapidly, so you're investing in future growth. Well, if you just look at the back and forth that takes place year after year, and you go back a century, what you'll see that is, on average, value stocks have outperformed growth stocks by about 4.4% per year. And that's not nothing, as they say. So we've had a bit of a growth run lately, but I recall back in the late 1990s when just about every investor I talked to defined themselves as a growth investor. And it was only a few years later where everybody that I talked to, almost without exception, defined themselves as a value investor. We always want to be the type of investor that's aligned with what's working at the moment. But there's no good indicator for when those are going to trade leadership. And so what we know is that over the long term, having a tilt toward value tends to work the best. So it's just one of a handful of things that we do in your portfolios that have tended to work more than half the time. And the more of those you can do, the better returns you're likely to get in the long run. Just a few disclosures there to the prior slide. And then let's talk about the future. The headline here is expecting the best. And so we've been able to be optimistic all year long, just like we were the year before. And the but has to do with a few things that I'll show you here, but of course also some of the concerns that we listed at the very beginning of the presentation. So let's just talk about economic growth for a moment. Economic growth has been quite solid. Now, there's been some interesting updates to prior history that's come out this quarter. For instance, there was a report that dramatically reduced the number of jobs that have been created in the last 18 months. But just a few days after that, we got an update that revised upwards the 2022 rate of GDP growth and also the 2023 rate of GDP growth. So I've said it before and I'll say it again. When we get a GDP number, and we did this week, and it was pretty decent, what we know is that that's not the final number. It is going to be revised time and time again. As I said a moment ago, we just revised 2022 GDP growth. My favorite indicator, therefore, is the weekly economic index, and it's a bit more noisy or volatile. That's that blue line that you see on this graph. So it bounces up and down a little bit, but over the long run, that tends to correlate very nicely with the eventual GDP numbers that we're able to prove out. And what we see with the weekly economic index is that we're cranking along at about 2% annual real rate of economic growth, and that's what sits on top of inflation. That's running, 2.5%, let's say. So actual nominal GDP growth is running at around 4.5 right now, over and above inflation. That's about 2 with that bouncing on a weekly basis. So very healthy, very steady, a lot of certainty and calmness, if you will, in that track record. And we never saw a reason to predict that there was going to be a recession, and we're not seeing one now. So the U.S. economy just continues to crank out this nice, stable rate of growth. Here's an inflation chart that I've never shown anyone before. This is inflation in many of the major developed economies. And what you'll see is that inflation across all these economies was bouncing around a bit until we got to the pandemic. And then they all tended to correlate. And within a year of the pandemic, a couple of things had happened. One is all these major central banks followed the lead of the Federal Reserve. And so the recession only lasted in the U.S. about 3 months from the pandemic because of all the fiscal stimulus and all the monetary stimulus that the government threw at it. And yet the Federal Reserve continued to keep interest rates at essentially zero. So the Federal Reserve keeps interest rates at zero, and then all these other central banks follow suit. You get a bit of a problem, or a knock-on effect, as they say. And what you see is that inflation got ignited all over the globe, certainly in the UK, where they just had big and somewhat surprising election results. In fact, in the UK, they're now below their target rate of inflation of 2%. It's down to 1.7 and continuing to fall. So what we see now that all these central banks are finally catching up to the Fed is that inflation is falling. So they all raised rates substantially. And that was just one factor in inflation. One of the reasons we had so much inflation, in addition to the Fed overstimulating the economy, was the fact that the Russian invasion of Ukraine helped to tie up a lot of supply chains around the world. China's policy of absolute lockdowns and zero tolerance meant that supply chains were gummed up, and so things got a lot more expensive because of that. So the Federal Reserve had access to all that data while it kept its foot on the gas, but now it's in the opposite posture. It's driving inflation down, and I think that it is underestimating the capability of capitalism to figure out a way to produce more cheaply and to deal with inflation. And so right now, the economy is favoring those companies that are finding ways to cut costs and be more efficient and bring prices down. And so interest rates are still kind of high. I'm going to predict that we're going to continue to see prices fall, and hopefully we're not going to join the UK and get back into the territory where the rate of inflation is actually too low, because deflation can be a real problem. Here's a little bit of foreshadowing of what we might see in the next 3 to 6 months with regard to inflation, assuming that you don't see a wider outbreak of war in the Middle East. What we're seeing with prices that fell the most here is that was in heating oil and various types of crude oil and natural gas and unleaded gas, what's known as RBOB in the commodities industry. And when carbon-based energy gets cheaper, that has a ripple effect all throughout global economies. There's a lot of other commodities and products that are based on the cost of energy. And so when those get cheaper, it's not just cheaper gas at the pump, but it's a lowering of the rate of inflation or potentially deflation all across the economy. So this kind of pullback in those prices suggests that we can expect some milder inflation reports. Sometimes it takes a couple of months to work its way into the pricing, but right now that's the best expectation. And again, the UK might need to be ready for seeing some negative inflation. They're a little bit ahead of us in that regard, and hopefully we don't go there either. Here's an employment chart, and I began showing it this way last quarter. Let me just show you what these two lines mean. It makes it pretty simple to understand what's going on in the labor market. The blue line shows you job openings, and the red line shows you the workers in the job market ready to fill those. So in this case, the unemployed includes the discouraged workers, folks that are on the verge of giving up. And it's really the total for workers that could be brought to bear if the job is right, if the salary is right, so on. So when you've got this kind of gap, the blue line is above the red line, you can be fairly confident that the job market is going to continue to be positive, that we're not going to see big employment losses. You may see little hiccups here and there. And honestly, we're in a situation right now where bad news in the labor market is good news. And so a job report that surprises to the downside is the kind of report we need, that the stock market, frankly, is going to love, because this gap is hard on companies. The economy just functions a little bit better, quite honestly, when the red line is a little bit above the blue line. And so we're going to get there. Are we going to do that in 6 months or a year and 2 years? We'll see. But we can certainly tolerate some negative job numbers, and I think the stock market would love it. Okay, we're going to show you a couple of slides of data, and at this point, I think our clients have learned that we're just here for the data. We're never here to make a political point, but maybe there's an additional subtlety to this slide that's worth looking at. This, by the way, is a prediction of the effect we will see on budget deficits based on what we call a central cost estimate of what the two major candidates have proposed. So this extra point that is worthy of keeping in mind is this: what candidates promise prior to an election and what they will deliver, what they can deliver after the election, are two very different things. And right now there's a bit of an arms race, if you will, for all the tax breaks that both candidates want to offer the electorate. And if you're a server or a bartender and you're not going to have to pay tax on your tipped income, which is probably the bigger part of that, you think that's terrific. I think both of them are in favor of that. So there are some other differences, and some they're the same, but both are going to have a pretty negative impact on what our budget deficit is going to be in the coming years. So a little discouraging if you're one of those types of folks that would like to see a balanced budget. But again, take it with a grain of salt. We're just looking at analysis that came from a group called the Committee for a Responsible Federal Budget. They are a decidedly bipartisan group, economists, former politicians, folks in a position to know that come from all parts of the political spectrum, but share at least this idea that perhaps the country should be running on more of a balanced budget, and thus the name, the Committee for a Responsible Federal Budget. A more long-term thinking slide that looks at not just the central estimate of what would happen if the candidates got their way, but a low range and a high range, meaning nobody knows exactly what the rate of economic growth will be. Nobody knows for sure all the variables. And so really, if you want to do a more thorough analysis of candidate policies, you have a range of what those impacts would be, a low, a mid, and a high. So we just showed you the central estimate and put that in the table. What you see now is the bottom there. It's almost covered up, is what's going to happen under current law, which includes some prior tax cuts expiring at the end of 2025. In fact, the prior tax cuts could only be legislated into being with current budget rules in place because they were in fact required to sunset after 10 years. Well, we're coming up on that sunset. So a bit of a question here. And so now the current law looks pretty good, even though we have the size of our national debt rising consistently over the next 10 years to be a bigger and bigger percentage of our projected economy. But what you see is both candidates, their low range, their high range, and their central estimates with the solid line there would make that decidedly worse. Now, one of the impacts of an ever-increasing debt relative to GDP is that eventually the chickens come home to roost. And maybe we'll have time to talk about that at the end if somebody's got some questions. But there is no candidate running on higher taxes and lower spending and the kind of things that are gonna not make a lot of individuals happy, but maybe make us more secure as a country. Instead, you've got a competition for spending and tax cuts that are all quite appealing on an individual level, but certainly would make this problem worse. And so with all of that in mind, perhaps a good time to remind you that we do more than just invest in cash, fixed income, and equities. Individuals can do that. Other competing firms do that. There's a lot of extra things we do, like our hedged yield and hedged equity. And boy, I love getting thanked by our clients that have invested in those. And of late, in particular, the hedged yield, because we call hedged yield synthetic fixed income, and it's done way better than the fixed income indexes for sure. We've got the private fixed income, the private equity. We've talked about those extensively over the last year and prior years, of course, as well. And clients that have been doing that for the last decade love looking at their 10-year returns compared to their benchmarks. And then of late, we've rolled out the BIP short-term tactical, a great way to invest in those higher returns we can get from the short end of the Treasury yield curve, while still being very, very safe and investing in a way that we're not so worried about FDIC limits, such as you might be at a bank. And then, of course, I've mentioned it a few times this year in these presentations. If you've got a lot in one stock, we think that's dangerous, but we have a strategy that uses options to take away about half of the daily risk, and we call that our BIP concentrated stock strategy. So if you've got a lot in one stock, you might want to see if there's something we could do to take away some of that risk there in a very tax efficient way. So just to wrap things up, we've got these key themes. We haven't seen manifest some of the things we've been worried about this year, at least not yet, but you know, we've got a few more months to go. So let's hope that we can make it through. But we think our key themes have guided us well this year. As I said before, the U.S. presidential election has the whole world on edge, but if for a moment we can be focused on just what it means for our investments, long-term history is on our side to suggest that we should all just stick to our financial plans, and that'll be the most prudent course for what we do with our money. So again, as we just showed, the BIP Wealth folks have a pretty nice toolbox of things to bring to bear for your particular investments. And so that's just it's a far bigger toolbox than I'm aware of existing at any other firm that competes in this space. And so whatever are the particulars of your situation, there's probably something that we can do to help, maybe something we can do that someone else can't do. And we're excited about the fact that every one of our investors has a very individualized investment plan. And if your advisor is suggesting a new strategy to you that maybe takes advantage of one of those tools in the toolbox that you haven't used before, that could be a very worthwhile conversation to make sure that you're getting the kind of risk and the kind of returns that you're expecting.
Great. Nice job, Eric. Really good presentation. We already have a couple of questions. The first question, Eric, coming from Josh. Despite the Fed lowering interest rates by 50 basis points, Treasury rates, specifically those for longer-term Treasuries, have gone up substantially. Is this a concerning trend, predicting a potential near-term recession, or issues with our national debt?
What a terrific question. And Bill, you might be grinning there, because before we started, I said, if somebody doesn't ask that question, you got to ask the question. But Josh asked the question even better than I would have expected us to be able to pose. And I've got three responses to that. So I'm just so excited to get such a terrific question. So the first is our investment style in fixed income takes away the risk of that happening, meaning your individual portfolio will do quite well with this current phenomenon that's manifesting. It's what caused some of those index returns to be so bad a few years ago. A couple of years ago, the index was down over 13% for the year, and we were way ahead of that, and we're ahead of that now. So just individually, you can feel good about the way your portfolio is invested. So that's point number one. Point number two is, am I concerned? And in a way, I'm actually excited. And here's the way to think of what the Fed does. When the Fed is managing short-term interest rates, it is a bit like if you were balancing a broom in the air on your fingertip. When you move the bottom of the broom one way, the top of the broom goes the other. So if you're balancing it, a broom or a tennis racket or something like that on one finger, it's the opposite. So when the Fed raises interest rates, certainly if they raise them too much, they crush the economy and long-term rates fall. When the Fed lowers interest rates, it stimulates the economy, and a robust and growing economy tends to cause long-term interest rates to rise. So again, it's a bit like balancing a broom tip from the bottom. The Fed's, you're going to see the long-term rate go the opposite direction generally of what the Fed's doing. Now, I say that in the context of the third part of the answer, which is this. If we ever get into a disaster scenario where we're too far gone with the size of our national debt, one of the things that classical economics warns us about is what we call the crowding out theory, meaning the government is borrowing so much money that nobody else can borrow money. So you and I may want to borrow money, corporations may want to borrow money, but when the government is borrowing so much money, we're all competing with each other. Well, what happens to interest rates? They go up. The government's got to offer to pay a higher and higher rate to finance the debt and get investors putting money there instead of with corporations and other places that they could invest. So one signal that we're too far gone and the size of the national debt is gonna ruin the party here is that long-term rates just continue to escalate. Now, I don't think that's what's happening right now. What I think is happening now is the second thing I mentioned. The Fed is lowering rates. It still needs to lower them more just to get out of the way. And if it will do that, that will allow us to have even stronger rates of economic growth. And, I've been in this business for a long time now, and there's not been that many times in my career where short-term rates were lower and long-term rates are higher. But when you take an economics course in college, what they teach you is that that's what we call a normal yield curve. That's the way it's supposed to be. So if the Federal Reserve will just kind of get out of the way of the economy and set rates where the market knows it ought to be, you'll have low short-term rates. That'll allow capitalism to function. The economy will grow at an even faster clip. Long-term rates will naturally be higher. So it's probably that good news scenario right now.
Good. It's probably just a normal yield curve trying to work its
way
back up. So. All right, Eric, the next question from Wendy in Louisville, Kentucky. On the first market recap slide, there was a reference to Korea. And was that in particular just South Korea?
Yeah, that is just South Korea. And the rules about listing countries follow a kind of a hierarchy. So we have developed markets like our own, and you have to have property rights and regulation and capitalism functioning more or less the way you'd want it to be with mostly free markets. Then you have this second tier that we call emerging markets, where some of those things don't work quite as well. So South Korea is certainly a developed market, but then you get other economies that are capitalist, and they're markets you can invest in, and they're called emerging markets. But there's always, a bit of a problem. Every emerging market's got a couple things where they could really improve on to get out of emerging markets and be developed. There's actually a tier below that we don't report on here called frontier markets, and that's that gray area between an uninvestable market like North Korea, where there's just no practical way to invest. They're so far away from capitalism and free markets as we know it that you just sort of couldn't find a worse example. They're not even frontier markets. You really can't get in there in any feasible way. So what we're showing is the top level developed markets, but then also the emerging markets, not the frontier, and then not the uninvestable markets.
Good. Next question we have is from Matt. So Eric, what, if any, changes to our investment philosophy do you foresee if a significant tariff regime is implemented by a new administration?
Well, as they say in the pharmaceutical business, or perhaps it's in chemistry, the poison has to do with the size of the dose. And so there's tariffs in place now. There's fairly new tariffs in place now that were started under the Trump administration and just largely continued by the Biden administration. There's tariffs in place now that were started decades ago, such as the 25% tariff on trucks built outside of the United States. And these tariffs, if you're very much a free market kind of guy, probably explain some lack of economic growth, at least in the aggregate. And it gets back to an economic concept that some of you may be familiar with called relative advantage, where you really just want the freest possible markets. The size of the total pie will be the biggest. And even if one economy is good at doing one thing, we need a tariff-free way for other economies that might be a little better at that thing to do that. So every country should kind of do what it's best at. And tariffs change all that landscape. You now no longer have free markets guiding kind of invisible hand, if you will, for who should make what. Now, it's interesting. We look at the number of foreign car manufacturers that have located to the U.S. As a byproduct of some of those tariffs, also trying to deal with currency translation problems, but they move some of that manufacturing to the U.S. to avoid the tariffs. Now, you could argue that some of that is good. We haven't seen similar effects happen in textiles and furniture, where now a lot of that manufacturing has, in fact, moved overseas. Perhaps with sufficient tariffing around that, we would have kept some of those jobs in the U.S., although that's kind of an odd thing to talk about right now, where we honestly have a worker shortage. So in the long run, capitalism found other things for American workers to do, but we didn't tariff our way out of watching that manufacturing basically move to Asia. So if tariffs are instituted across the board, and we do that here, and then we get the expected retaliation in other countries, we will all become a bit more siloed. So it is a tax on the ultimate consumer of those goods, but there's so many other complicated effects that happen. It's a little hard to say the net effect of what that will be. In theory, the total global rate of economic growth will diminish because you don't get this concept of relative manufacturing advantage being fully applied. But the U.S. may do particularly well under that. We're already a consumer economy. It may have even more manufacturing come here, but expect some inflation out of that. If, 2/3 or 75% of what you buy off the shelves at Lowe's and Home Depot and Walmart and places like that is made in China, that stuff's going to get more expensive. So one might hope that that's all set with other tax breaks and things like that. What the net effect of all that would be for an individual consumer is hard to say, but in the short run, it's potentially inflationary and could dampen economic growth. But that's a simple answer to a complicated question.
Good. Thank you, Eric. So, Eric, the next question is, with so much of the economy being technology-based, how much is our exposure to the tech sector? Is that the right amount of exposure to the tech sector? Do you see it beneficial or not to allocate more to technology?
Well, I will say this. There have been times in the company's history when we had more of a value focus than we have right now. One of the guiding principles of how we allocate to portfolios is, hey, it's great to stand on principle in the long run, but we don't want to be so extreme in any of our views that we create too much short-term stress or an inability to keep up. I'm aware of some firms that don't buy any growth; they only allocate to value, and I would deem that irresponsible. So we do have a fairly healthy exposure to growth. And a funny thing happens is these companies do pretty well. They become value companies, or blend companies at least, as the profits appear. And many of the top names actually that have profits, and a lot of that's been in the news lately, aren't growth companies per se. They're a blend. And so in fact, we do have exposure to those as they're profitable. So what we know is that in the long run, the value focus, regardless of what industry it comes from, tends to work. But many of the most profitable companies aren't even really considered growth companies anymore. And we do have exposure to those. So this value tilt might not be having quite the effect that we think it does if we only think of the technology companies as being part of the growth sector. What we do also know is that when growth gets punished, it happened a couple of years ago, growth stocks really took a hit, and our exposure to value kind of saved our clients in that down market, if you will. And then, of course, if any of you have been doing this for long enough, you'll remember what happened in the early 2000s when tech got to be, I think at the time, more than 40% of the S&P 500. And just about 2 years later, I think it went from 40% to 13%. You could have just been indexing the S&P 500 and you were overexposed to technology. So kind of an odd thing. At the same time right now, tech has been such a part of our lives for so long that technology, one way or another, is really a part of every industry that you're investing in. And I'll point to AI as an example of that. I think in the long run, it's not the makers of AI that are going to get the biggest benefit. It's going to be the users. So you can be buying utilities and consumer staples. And if those companies are implementing AI well, they'll get huge advantages from that. So that'll be just pervasive across all sectors, frankly. So this technology question is a thorny one, a complicated one, but hopefully I shed some light on some of the subtleties that exist within how we all use technology now.
All right. Well, that wraps up the questions that we have here, Eric. Thank you for the presentation, and thank you for answering the questions at the end. And thank you again for joining us today.
Thanks, everyone.